All right, let's go ahead and get started with Chapter 1 of Managerial Finance in the MBA program. Really, we want to talk, before we get too much into detail, a little bit about what we're going to discuss over the next couple of weeks. Corporate finance itself really answers or addresses three questions. Number one is, what kinds of things should the company buy? We'll develop and ultimately utilize and test a model to establish the value of assets for a firm. The second thing that we'll then look at is, once we've decided what the things are that we want to buy, that is, once we do step one, we need to address the issue of where do we get the money to pay for things. So we're going to look at the variables that are utilized to determine whether or not companies should borrow money or whether they should use owner money. And finally, the third thing is we're going to address some short-term financial questions. How do we manage short-term assets and liabilities? What are the processes for that? So again, let's kind of move on a little bit and see if we can talk about these things and the key concepts or the constructs of finance. Financial decisions are based on what's referred to as a risk-return trade-off. There's a connection between the risk of assets and the returns that investors want. This ultimately impacts everything. It impacts the value of the assets. It impacts the costs of financing assets. Number two, the time value of money is the key construct. It's the mathematics of finance. It's how we analyze the data in our techniques to determine what the value of assets and projects are. Cash is not Cash is the king. Cash is ultimately the most important aspect of finance. Profit is not. And we'll talk about this in some detail, but profit, although it is very important, is not ultimately that thing that we want to utilize in our techniques, if you will. We're going to look at incremental cash flows, what happens once we make decisions. So not what the company is doing today, but the changes in cash that move forward. We're going to talk about competitive markets. Most finance theory is based on the construct that we have competitive marketplaces. However, in reality, markets are not perfectly competitive, and that creates, in some aspects, some good things for us, and some other things it is a detriment to making financial decisions. We're going to talk about the efficient market hypothesis. How do managers think? The efficient market hypothesis has to do with the mechanism that creates prices. It's a supply and demand mechanism, and the demand curve for stock prices in particular is driven by investors and their information that they gather. The agency problem. How do managers think? What is the process of the decision making at the manager level? We're obviously going to look at taxes, how they influence decision making. Ultimately, they could be a detriment to making decisions. We want to, again, spend a lot of time talking about risk. All risk is not the same. There is different kinds of risk, different aspects that we'll need to discuss. And then finally, number 10 here is that essentially ethics is the driving mechanism of everything that we do and talk about. All decisions should be made in the context of ethical decision making. So let's kind of move on. We have there are essentially four kinds of companies, or four types of firms, if you will. I'm sure you recognize all of them. As we work our way through, though, we want to discuss the techniques of capital of corporate finance. Obviously, that's the context of the course. However, all the techniques that we talk about can be incorporated or adjusted to fit any type of business. So sole proprietorships, there's one owner. Partnerships, obviously there's two owners or more. Corporation, we offer stocks, bonds, etc. to investors. And a limited liability company is a mutation or a hybrid, if you will, between a partnership and a corporation. So if you kind of look at the first little picture here, it shows how businesses can be characterized, if you will. See that about 71% of the companies are sole proprietorships, or actually a little bit better way to look at this is only 19% of all corporations, of all businesses are corporations. So they're a very small segment of our economy, if you will. And of those corporations, only a small segment of those corporations are publicly traded. On the other hand, if you look at the amount of revenue, 84% of all the revenue comes from corporations. So it's the corporation that ultimately provides revenue, obviously to its owners, investors, but also this has some obvious implications for taxation. Right? If we increase the taxation or increase taxes on corporations, certainly they are going to react to that. But ultimately, you want to place the tax burden where the greatest amount of taxes for the least percentage can ultimately be gained. So what about a sole proprietorship? Obviously, there's one person. They typically have very few, if any, employees. It's very easy to create. The challenge, though, is really twofold. Number one, is it has an infinite life. Excuse me. It has an infinite life. If the owner decides to do anything, if they decide to quit someday, the sole proprietorship's over. If they pass away, the sole proprietorship is over. So it has a limited lifespan. The additional part here talks about liability. Unlimited personal liability essentially means that the owner's assets, both his personal assets and business assets, are viewed as being one pile. So should anything bad happen to the company, the creditors or the people who are entitled to assets from the company can take whatever they want. And of course, if the owner's rather successful, probably has lots of nice personal assets, but maybe the business doesn't have many assets. So this is actually one of the critical challenges to a sole proprietorship. It's the riskiness of being sued and what that ultimately could do to the wealth of the owner. Partnerships, very similar to sole proprietorships, except there's more than one owner. Essentially, all partners are now personally liable. So that unlimited liability of the sole proprietorship falls through to what are referred to as our general partners. And again, when a partnership ends, it could end with the death of a partner or a withdrawal of a partner. So partnerships, general partners, are very similar to sole proprietorships. A limited partnership has a little bit of a hitch to it. There's actually two kinds of partners, a general partner and a limited partner. And the idea here is that the general partners have this unlimited liability. They run the company on a day-to-day business. The limited partners, however, are essentially what we used to refer to these as silent partners. All they do is contribute investment money, but they're not allowed to take any management authority inside the company. Having said this, since they don't participate in the business and they only have the investment to show for their ownership in the company, they also have what's referred to as limited liability. They can only lose that investment. They cannot lose anything in addition to that. A limited liability company is a relatively new kind of business, but in this case, instead of there being general partners and limited partners, all of the owners have limited liability, and they also can all participate in the business. So there are a lot of different kinds of or types of businesses beyond these four that we're going to talk about. We have subchapter S businesses. There are master partnership businesses. There are limited liability partnerships. There's a variety of different types of businesses that are hybrids of the three primary businesses, which is sole proprietorships, partnerships, and corporations. A corporation is a legal entity. It has all the legal powers of a person with the exception of being able to vote. It's responsible for its own obligations. Its owners are not responsible for its obligations. So let's kind of look at a corporation, right? You're a shareholder. The corporation owns $5 per share before taxes. After it's paid taxes, it's going to distribute the earnings to you as a dividend. The dividend income to you is income to you, so you're going to have to pay taxes on it. The corporate tax rate's 40%, and the dividend income is 15%. So the question is, how much money do you ultimately get in the end? So first of all, the government the corporation pays taxes. It earned $5. It's going to have to pay 40% tax. 40% of 5 is $2. So that leaves $3 to distribute. So it's going to distribute this $3 to you. However, you have to pay a 15% tax on the $3. That's 45 cents. So in the end, you receive $2.55 is the amount of all the taxes are paid after taxes. So ultimately, you pay $2.45 in tax, you get $2.45, and essentially what that tells us is that there is an effective tax that owners pay. It is the accumulate. It's an accumulation of all taxes, both at the business and at the personal level. So in this case, owners effectively pay around a 49% tax bracket. I guess the question is, what would happen if this is a subchapter S business, and then the tax on non-dividend income essentially is 30%. So what tax would you pay? Well, again, 30% of the $5 is $1.50. So in the end, that's a lot less than have to pay the $2.45 in the previous chapter. Now, obviously, this subchapter S is a different type of business entity, but it's a business entity that essentially you pay taxes as an individual, and you don't have to worry about double taxation, which is double taxation at the government level or at the corporate level, excuse me. So essentially, instead of paying about 49% taxes, again, you're only paying 30% in taxes. The corporate management team, obviously, you know, there's a corporation, is in direct control by shareholders. However, the shareholders don't deal with day-to-day business and the ongoing strategies, etc. of the business. The board of directors are elected by shareholders, and essentially they have the strategic planning of the company. They hire the executives of the corporation, and they essentially oversee this broader range of strategies, paying of dividends, etc. It's the CEO that delegates the day-to-day decision-making of the corporation. So they're ultimately in charge with the production, the providing of services, etc., the production of revenue, That is the job of the CEO. So again, let's kind of go back. What is the financial manager responsible for? Investing decisions. They're in charge of trying to figure out what assets the corporation needs in order to do the things that we would like it to do for us. In addition, they obviously look at financing. They determine what the corporation's policy is with respect to the borrowing of money and the using of shareholder money. And then ultimately, they have control over the analysis of cash management to determine that the company has enough cash to do the things that need to be done to ultimately to do the strategy to move the corporation forward. So now we're going to switch gears just a little bit and talk about something called the goal of the firm. And I like to think of this a little bit more like a benchmark, if you will. Shareholders will agree that if management makes decisions that maximize the stock price, they feel like they're better off. In fact, I think if you were pretty cynical, and I think I'm a fairly cynical person, that's really the only thing shareholders are interested in. Shareholders have an investment in the business. They have an ownership interest. Their one and only goal, their one and only hope is that the value of that asset, whether it be through the distribution of dividends as a payback or through the increase in value of the company, that is their one and only goal. So that should ultimately then be the primary goal of financial managers. Now, there are a lot of goals, though. There are a lot of things that we can use as variables. We could talk about maximizing profits and costs, or minimizing costs, maximizing market share. I mean, all of these things are certainly very important goals. They're objectives that we would like to hit. But I think in the end, the question ultimately is, really, what should management use as the variable to make a decision? When they're doing this, what outcome should have the highest priority? And from the perspective of ownership, owners have the concept, the idea that they want to see the value, the wealth that they have invested. They want to see this grow. The two primary ones that we typically talk about are maximizing profit, and then, of course, what we've been talking about, maximizing shareholder wealth. So why is maximizing profit not our highest priority? Well, for several reasons, and some of these will become, I think, crystal clear as we work our way through the class. But essentially, profits are backward looking. Decisions in the company are made looking forward, not looking backwards. Profit is dependent on accounting principles. It doesn't fully consider cash flow timing. It doesn't move money back and forth in time as we need it to move, so we can make proper decisions. Quite frankly, it totally ignores the concept of risk, where maximizing shareholder wealth is the proper benchmark. Modern finance claims this as the gold standard, if you will. So maximizing stock price, not profits, should be the primary goals. And I guess when you get right down to the bottom line, stakeholders are referred to as residual claimants. They give us money, and we return them money only if there's something left over. They bear the greatest amount of risk on invested dollars in the company. So they're not going to take on these risks unless we can provide them some form of return. They want to increase their wealth. Another topic to discuss refers to what's in the corporate research world is talked about as being an agency problem. Managers tend to act in their own best interest rather than in the best interest of shareholders. This is what's referred to in economics as somebody as being a rational decision maker. There's nothing really wrong with this. This is the way people think. The challenge is there's a conflict. Shareholders want managers to only do those things that increase wealth, increase the stock price, but sometimes managers want things that increase their personal wealth. So how do we tie this in to decision making so that managers do what we want them to do? How do we measure performance, in other words? Should we use earnings per share, net profit margin, a concept called economic value added? I mean, how should we measure performance? And the answer is there's no research that's been done that shows us what is the best way to measure performance so we ultimately understand whether managers are doing a good job or not. So what can we do to help managers to make them think more like owners? Well, we can do things like corporate control or have an understanding of corporate control. A takeover can frequently happen if management doesn't do a good job. In particular, we have leveraged buyouts where a small group of owners gets together. They get tired of management. They don't feel like they're doing a good job. So they take over the company. Of course, they fire the managers. This actually brings up a topic or a terminology of something called a hostile takeover. A hostile takeover is one in which the managers of a company do not want the merger to take place. So you need to ask the question, if the managers don't want a merger to take place, what's their motivation for that? Well, their motivation for it is they know that they haven't done a good job and they're probably going to get fired and lose their position. That's a hostile takeover. A friendly takeover is one that management team wants to happen. Again, what could their motivation be? Well, there's lots of reasons why mergers happen, but in this context, you might then just raise an eyebrow saying, well, in one case, they don't want it to happen because they know they're going to get fired. Why would they want a friendly one to happen? In the friendly takeover, maybe they're not going to get fired. Which one's better for the current shareholders? And there's lots of arguments that the hostile takeover is actually better for the owners of a corporation than the friendly takeover. What about an audit function or an insurance arrangement, right? We ask, the SEC requires companies to audit their books. However, as a sidebar, as an additional benefit of having our books audited, managers now need to sign off on the accuracy and the quality of the information that they give us. So this should give us more information about both good and bad things that are happening inside the company. And finally, I guess we can talk a little bit about compensation. How should we pay managers so that they think most like an owner? The best way, quite frankly, is to do this is just to pay people in stock. So when you go to get your paycheck, you open your envelope and there you have 15 shares of stock. The challenge with that is, how do you buy groceries with stock? You don't. You have to convert it. So there are some challenges with how we pay managers. One of the tools that we have at our disposal are options. And there's lots of different options, but I think most of us have heard about employee stock options. An option in this context is essentially the right to buy stock at a certain price within a certain period of time. What this does is creates two places where you can go to buy the stock. So here's an example. You have an option to buy a share of stock for $50. A piece of paper says, anytime you want, within a certain period of time, you can give us $50, we'll give you a share of stock. The challenge is the current stock price at the stock market's $35. So if you wanted to buy stock, you certainly wouldn't pay 50 if you only had to pay 35. So you'd go to the stock market. However, if we've been able to increase the share value, make the stock price go up, what happens if someday the stock price is $65 and I have an option for 50? Would you rather pay $50 for a stock or 65? Well, obviously you'd rather pay $50, and immediately you could sell the stock, and in this case, you'd have a $15 option or profit on the transaction. So let's just take another step forward, and let's think a little bit more about some terminology. Right? We want to talk about the stock market in general and what the stock market provides and creates for us. The stock market creates a place for shareholders. Number one is to have liquidity. So that is, it's very easy to buy and sell assets at a price that is created within this mechanism. So it helps us create prices that, quite frankly, through something called the efficient market hypothesis, we can have some confidence that that price adequately represents the true value of the company. Liquidity, on the other hand, just gives us the ability, number one, to become owners, but also to become to get out of the ownership business should that be something we want to do. The final context or piece of terminology we want to talk about in this chapter has to do with how do corporations ultimately get money? And we have two kinds of markets, if you will. We have something called the primary market and then the secondary market. The primary market is when a corporation issues shares for the very first time. These are could be referred to in two different ways, I guess. The first way is through something called an IPO. In an IPO, it's when a corporation issues stock for the very first time. We've had several of these over the past years that have been very large. Visa, Google, Facebook, all of these have been what are referred to as primary market transactions. The current owners of the corporation take their investment and ultimately provide access to other owners. So it's a way to get money. It's a way to increase the size of the corporation. But it's also a way for the founding fathers, if you will, to ultimately gather some money for their efforts and their risk-taking while the company has been growing. The secondary market transaction happens after the corporation has been created, and this is where investors trade between investors. The key difference between these two is who gets the money. In the primary market, the corporation gets the money. In the secondary market, the money trades hands between investors. That is the end of chapter 1. A little bit of a review. We'll see a picture of where we're moving forward. And we will talk again in chapter 2 when we get down to talking about some analysis of the company, of the corporation.